Hi, my name's Vishwa. My group members' names are Siddharth and Prem, and we are group five. Our topic for today was swaps and swaptions. So, what are swaps? In the simplest of terms, a swap can conceptually be seen as a series of forward contracts or a portfolio of forward contracts. It's basically a derivative contract between two parties where they agree to exchange sequences of cash flows or liabilities based on two financial instruments for a certain fixed period of time. Of these two cash flows, one cash flow tends to be fixed and the other cash flow tends to be a floating or a variable based on a certain benchmark interest rate, index price, or currency exchange rate. So there are many different kinds of swaps, such as commodity swaps, total return swaps, debt equity swaps. But the two most common types of swaps that we have are interest rate swaps and currency swaps. Unlike futures and options, which are traded on a public exchange, swaps are actually customized contracts. So they're basically traded over the counter. So swaps are traded privately, and there's always going to be an underlying risk of default by counterparties because of this. So let's talk about one of the most common types of swaps, which is an interest rate swap. The most common type of swap is a plain vanilla interest rate swap. So let's explain this through an example. Consider there are two parties, party A and party B, and they enter into an interest rate swap. Party A would agree to pay party B a certain predetermined interest rate on a set notional value at specified dates for a specified period of time. And in return, party B would also agree to pay party A a floating rate of interest for the same notional value and time period, etc. So the parties know from the beginning that they're not going to be interchanging the other party's debt obligation. The only thing that they do is swap interest rate payments. So if we look into this in more detail, suppose that the notional value of this swap agreement was $100,000. Company A seems to believe that the interest rates are going to increase in the future. And so they have a more optimistic outlook on interest rates. And company B seems to think that the interest rates are going to decrease later on in the future. So they have a more pessimistic outlook on interest rates. So company A believes that the variable interest rates have the potential to rise over the next 2 years, and they want to profit from this. And company B believes that the variable rate will possibly go down. And so his interest rate returns, he think, are going to decrease. So he is trying to hedge against this particular opportunity risk. So for this reason, company A and company B decide that an interest rate swap is the best possible way to achieve their particular financial goals. Company A will agree to pay company B interest payments of, say, suppose 6% of the notional value in exchange for a fixed interest rate of LIBOR plus 1%. And LIBOR rate at the beginning will assume is 5%. So basically, at the beginning, both of the values are nullified. So it's 6% and 5 plus 1%, which is also 6%. Company B receives the fixed payment of 6%, and company A receives the variable rate of 5% plus 1%. And the two possible scenarios in this would be that, say, for example, the variable rate, which is the LIBOR rate, increases. So company A already thought that there was had an optimistic view, and therefore they were receiving variable interest rate payments for giving fixed interest rate payments. So in this case, company A would profit. But say in scenario two, the LIBOR rate decreases. So company A still owes company B a fixed return, but now in this case, company B profits because company B had a pessimistic view of the entire scenario, anyways. And so now they were receiving the fixed interest rate payments for paying variable interest rate payments, and therefore in this case, company B was profiting.
Yeah. Hi, I'm Prem. I would like to explain the types of interest rate swaps. There are three major types of interest rate swaps. Those are fixed to floating swap, floating to fixed swap, float to float swap, which is also called basis swap. Coming to fixed to floating swap. A fixed for floating swap occurs when one party swaps the interest rate cash flow of fixed loan with those of floating rate loan held by another party. Doing this swap reduces interest expenses by swapping for floating rate if it is lower than the fixed rate currently being paid. For example of fixed for floating swap, suppose X company carries a 100 million loan at a fixed rate of 6.5%, and company X expect that the general direction of interest rates over near intermediate term is down. The company Y is carrying 100 million loan at LIBOR plus spread has an opposite view. It believes that interest rates are on the rise. Company X and company Y wish to swap. With the fixed for floating swap, company X will pay the floating rate and thus benefit. In fact, the interest rates drop, and the company Y will assume payments for the fixed rate loan. Company Y will stand to benefit if the interest rate rise. Swap transactions are facilitated by a swap dealer who will act as a required counterparty for the fee. And coming to floating to fixed swap, these are exactly vice versa to fixed to floating swap. And float to float swap is normally called as a basis swap, where basis swap is also known as float to float swap. It is an agreement between two parties to swap variable interest rates based on the different money market reference rate. A basis rate swap helps a common hedge against the interest risk rate that occurs as a result of company having a different lending and borrowing rates. The two parties of the contract, known as the counterparties, can customize the basis rate swaps, including the schedule of payments. One of the most common form of a basis rate swap is a plain vanilla swap, where a floating interest rate is exchanged for a fixed interest rate or vice versa. Advantages and disadvantages of floating rate and fixed rate loan. So coming to the advantages of floating rate loan, applicable interest rate tends to be lowest available at the time of loan is initiated, and there will be a lower interest expense that can be reduced, and no need of and more advantages of floating rate. Advantages of floating rate are no need of international management of exchange rate, and there is no need for central bank frequent intervention, and no need of elaborate capital flow restrictions, and greater insulation for the other countries of economic problems. And the disadvantages of floating rate loan are there will be a higher volatility in the market. If there is a higher volatility in the market, then there will be a huge loss for the borrower, and there is a tendency to worsen existing problems. And disadvantages of fixed rate. Advantages of fixed rate loan are the risk changes of the interest rate market are removed. There will be the no risk rate. It takes advantages of favorable rate of environment to lock in long-term investment stability loan. The disadvantages are it will be the more expensive when the interest rate are lower. The prepayment penalty may be required if the loan is paid off early.
So now I'll tell you why and who would use a swap. There are two broad reasons for parties to enter into swap: commercial needs and comparative advantages. In other words, companies would enter into swap agreement to hedge their interest rates exposure risk, or if they speculate that the interest rates will move in a certain direction and wish to potentially profit from this speculation. How do swap banks work? A swap bank is an institution that acts as a broker between two parties who wish to get into swaps contract. When the swap banks brings two parties together, it earns a slight premium from both the counterparties. A more detailed example of this working is as follows. Assume that both company A and company B wishes to borrow a $5 million loan from their respective banks, Bank A and Bank B, in order to expand their business. Company A is a large, more well-established company, and company B is relatively smaller and newer company. Company A wishes to borrow at a variable rate and company B wishes to pay at the fixed rate of interest. Company A's bank agrees to fund the loan at either a 7% fixed rate or at a variable rate interest LIBOR. LIBOR is set by the banks altogether and can potentially change daily. Company B's bank also agrees to fund their loan of $5 million, but because it's not as well known, they charge Company A an interest rate of 10% or a variable interest rate of LIBOR plus 1. Now, the swap banks come into the picture. The swap banks would tell its client Company A to borrow at a fixed rate of interest and would tell its other client Company B to borrow at a variable rate of interest, that is LIBOR plus 1. The swap bank will get into two separate swap with each of their client. They will agree to pay Company A fixed rate of interest, which is 8% for the variable rate of interest LIBOR, and they will agree to pay Company B a variable rate of interest LIBOR for a fixed rate of interest, say 8.5%. The way the swap banks make money in this case, that the swap bank is receiving 8.5% from Company B and has an agreement to pay Company A 8%. The difference, 0.5%, is the swap bank's profit. The LIBOR paid by Company A to swap bank is equivalent to the LIBOR paid to Company B by the swap bank. Now, how does this benefit Company A and Company B respectively? Company A initially wanted to pay the lowest possible fixed rate. The lowest that Bank B was willing to go was 10%. With the swap in the place, LIBOR mathematically cancels each other out. That is, the LIBOR that the swap bank pays to Company B goes towards paying the bank the necessary interest rate. So what Company B is effectively paying is 8.5% plus 1, which is equal to 9.5 fixed, which is less than the 10% fixed rate the Bank B was demanding. Hence, Company B benefits. Company A initially wanted to pay the variable rate LIBOR. As a result of the swap, the Company A pays LIBOR to the swap bank but receives 8% from the swap bank. But Company A only pays 7% to the Bank A. So the fixed 1% saving on the notation value of $5 million. In other words, Company A is paying the swap bank effectively LIBOR minus 1%, which is less than the initial wanting of paying LIBOR. This is considered as a comparative advantage. Risk of swaps. Swaps have two major risks associated with them: interest rate risk and default risk or counterparty risk. The actual interest rate will never be certainly known in advance. That is, the interest rate does not always match the expectations. Swaps do not trade on an exchange, that is, they trade over the counter. Hence, they are not regulated by any regulatory body. Because of this, the swap have a risk that the counterparty will default. Central counterparty assists in mitigating the risk to an extent. A large amount of swap contracts are cleared through these central counterparties. The CCP collects a certain sum of money from both parties involved in the swap contract to cover the potential losses of a default. In a case of default, the CPP replaces the trade with the current market price. So, interest rate swap investors may have the perception that the synthetic fixed rate debt that is made available through the swap market is identical to the actual fixed rate debt. During period of economical violation and uncertainty, these swaps may not be very economically effective. These swaps are a separate entity from the actual debt obligation and must be settled separately. These swaps contracts may have clauses regarding earlier termination, and this clause can be misused and abused.
So we're going to talk about the pricing of interest rate swaps. The value of a swap at the beginning of the contract is always going to be zero for both parties, which means that the value of the fixed leg and the value of the flexible leg are going to be equal at the beginning. So if the notional amount is say $10,000, then the value of the fixed would be say 5%, and the value of the flexible would be done in such a way that it would also be equal to 5%. So the theoretical swap rate that we have to find out before we enter into such an agreement is the present value of the floating rate payments upon the total notional principal into the days into the discounting factor. So we can consider an example to understand the steps more. So say company A and company B decide to get into a $10 million plain vanilla swap agreement, and it has a 3-year maturity. So company A will be paying the fixed rate, that is the swap rate, to the company B, and company B will be paying the variable rate, which is, in this case, we're going to take the 6-month LIBOR rate to company A. So step 1 of the pricing method is to calculate the numerator. Now the numerator, as we mentioned, was the present value of the floating rate payments. So the way that we calculate the present value is we forecast the future semi-annual payments, and we take semi-annual payments because we took the 6-month LIBOR rate as our floating rate. So we forecast the future semi-annual payments using the LIBOR futures rate up till January 2024, because this contract was entered into in January 2021, and the maturity was for after 3 years. So we calculate the present value of each individual payment for every 6 months, and the total of this is taken as the value of your numerator. Your second step would be calculating the denominator. So the denominator is the present value of the notional principal, which in this case we took as $10 million. So we would take the notional principal, we multiply that with the days in the period, and in this case it would be 3 years, and we take the floating rate forward discount factor, which you can always find with the help of your financial calculator. Step 3 would be to calculate the actual swap rate. So now that we've calculated the numerator and the denominator, we can use this to calculate the swap rate using this particular formula. And step 4 would be to calculate the swap spread. Now we know the swap rate after we do the above 3 steps, but now you want to calculate the swap spread. So the swap rate tends to be compared with a US Treasury security of similar maturity. So in this case, the swap rate was found for a 3-year swap agreement. So we would take a US Treasury note with a 3-year maturity period as well, and we would compare that with the swap rate. So the difference between the US Treasury security and the actual swap rate that we calculated would be considered the swap spread.
And the swap pricing in the municipal market is priced very differently. It is priced with the help of the 3 components, mainly the US Treasury yield and LIBOR spread and sigma percentage. And US Treasury yield, coming to US Treasury yield, the US Treasury curve is used as a base for the risk-free rate. The US Treasury note, it is considered to have a virtually no credit risk, and hence it yield is considered as a risk-free rate of interest. LIBOR spread. LIBOR stands for London Interbank Offer Rate. When the banks in the London market borrow from each other, they borrow at LIBOR interest rate. This rate is variable and can potentially change every day. To calculate LIBOR for each day, the British Bank Association surveys 16 different national banks to find out what rate each one is charging for its overnight loan made to other banks. So the difference between the highest rate offered by the bank and the lowest rate offered by another bank is called the LIBOR rate. Sigma percentage stands for Security Index of Financial Market Association. Sigma stands for it is a weekly research index which consists of 650 various high-grade tax-exempt variable rate demand obligations. It is said to be around the same value as average municipal Viaggio yields in the long run theoretically. It means on any day, the rate determined on the basis of the 7-day high-grade market index of tax-exempt variable rate demand obligation as produced by the municipal market data and published or made available by the Securities Index and Financial Market Association. VRDO rates can be calculated as 1 minus marginal tax rate 1 minus marginal tax rate into LIBOR plus spread. The basic formula for Sigma swap rate is as follows. Sigma swap rate is equal to treasury rate of comparable maturity plus LIBOR spread into sigma percentage.
What is swaption? A swaption is a combination of swap and option. This means that a swaption gives the buyer the option but not the right to enter into an interest rate swap at a predetermined interest rate at certain fixed periods in the future. To gain this right, the buyer pays a fixed pre-decided option premium. Entering into a swaption gives you an extra comfort that if the interest rates rise above a certain level, the buyer of the swaption is insulated from the risk of the change of interest rates. In case the interest rates do not increase past the predetermined rate mentioned, the swaption is not exercised.
An example of a swaption is, say, company A has a borrowing facility and which needs to be refinanced in a year's time. Company A expects the borrowing rate to be higher 6 months from now and is worried that they'll not be able to afford this particular financing cost. Because of this uncertainty, company A wants to take out a swaption to protect themselves from the possible interest rate increased risk. In case the interest rates are higher at the time of maturity, company A would have the option to exercise their right to swap the interest rates. And in case that the interest rates are lower at the time of maturity, company A does not necessarily have to agree to go through with the swap, and they may simply just borrow at the prevailing market rate. The premium for the swaption is basically the cost of the swaption, and it depends on a lot of factors like the structure of the swap contract that you want to enter into and the interest rate decided for the swap contract. And a swaption tends to last from a time range of 10 days to as long as almost 3 years. So how does the swaption market work? Swaptions are mostly used to hedge certain debt positions. So if a company is worried about interest rates increasing in the future, or they would probably enter into a swaption to negate this risk. Swaptions are also used to alter the structure of a portfolio or to adjust a firm or investor's payoff profile. Swaptions are always traded over the counter because they're not exactly traded on an exchange. So they don't have a regulatory body. They are more of private contracts that are done between they're mostly done between larger firms. It's harder for smaller firms or retail investors to participate in this market because of the fact that it does not have a regulatory body. The market participants are also mostly larger financial institutions or hedge funds or mutual funds or banks. The main market makers are almost always commercial banks because monitoring this market takes a large amount of technological capital and human capital, and smaller firms and banks just can't afford this extreme investment. These contracts are offered in almost all major world currency denominations, such as the US dollar, the British pound, and also the euro. So what are the types of swaptions? There are two major types of swaptions, which is the payer swaption and the receiver swaption. A payer swaption is a swaption where the buyer has the right, but not the obligation, to be the fixed rate payer and the floating rate receiver. So any company or firm who believes that the interest rates are going to increase later on would want to enter into a payer swaption, because in that way they would receive the floating rate interest and they would only have to be paying the fixed particular amount of interest that has been decided in the contract. And the second type of swaption is a receiver swaption. So a receiver swaption is the exact opposite of a pair option. It's a swaption wherein the buyer has the right, but again, not the obligation, to be the floating rate payer and the fixed rate receiver. So someone who has a more pessimistic view of the interest rates and believes that the interest rates are going to fall in the future would want to be enter into a receiver swaption, because in that way they would be paying the floating rate interest, but they would be receiving a certain fixed interest rate which they would believe is higher than the amount that they are paying.
So what are the risks associated with swaptions? The one major risk with the swaption contract is if after the buyer of the swaption has exercised their right to swap interest rates, the expectations do not match with the actual outcome of the interest rate changes. The swap may actually give the opposite effect of what the investor was trying to achieve. To offset this risk, you have two options. Option one, you may terminate the swap. In this case, the bank will calculate the remaining value and pay you the residual value or vice versa. This residual value would be based on the difference between the swap rate and the current interest rate at the time of termination. Or this option two, the investor can enter into an offsetting swap agreement with the market conditions are when the market conditions are appropriate. Also, if the interest rates do not end up being higher than the rate mentioned on the swaption contract, then the buyer of the option would not exercise their right to swap the interest rates, and hence all the premium payments up till the maturity of the swaption contract would have gone to waste.
Advantages and disadvantages of swaptions. The main advantages of swaptions is it provides the buyer of the swaptions with a pre-decided maximum rate of interest. The buyer of the swaption has an option to benefit from lower floating rates prior to the actual exercise rate. In case of buyer wishes to terminate the swaption prior to the maturity date, then there will be no additional cost. The borrowers can also swell the swaption in case they wish to do so. The disadvantages of the swaptions are the buyer will have to pay the premium cost that led up to the maturity date. In case market remains below the swap rate for the tenure of swaption, the buyer has to fear that if they receive no value for the swaption.
The differences between a swap and a swaption. So the way that swaps and swaptions work are mechanically the same. A swap is an agreement to actually swap the interest rates, and a swaption is simply a contract where the buyer has the right to enter into a swap contract at a specified time period. So in short, the swap is an immediate trade, but a swaption is the right to enter into a trade later on in the future. An example explaining the differences is if a firm has issued debt and is expected to start paying their semi-annual 5% interest payments on it in 6 months, they have reason to believe that the interest rates will go down in the coming 6 months, which would mean that they would be paying a higher interest rate on their debt than the prevailing market rate. So to protect themselves from this, they may enter into a swap or a swaption. So scenario one, if the firm believes and is very confident that the price is going to fall or that the interest rates are going to fall, they simply enter into a swap agreement where they would receive a fixed rate in turn of paying a variable rate. In this case, the notional value of the swap agreement is equivalent to the amount of the debt obligation. So the firm is ideally just swapping out their fixed interest rate obligation for a variable interest rate payment. And scenario two. So, for example, say that the firm is completely unsure about the movements of the interest rate. They believe that the interest rates have a chance of going down, but they're also not sure and think that they also may rise. So, to battle this uncertainty, they'd rather enter into a swaption instead of a swap to hedge off their interest rate exposure risk. This would give them the option to enter into a swap agreement in 6 months' time. So in case the interest rate does in fact decrease, they could enter into the swap agreement and end up paying the variable rate of interest in turn of their fixed interest payments. But if the interest rate increases later on, they'd rather just not enter into the swap agreement altogether and instead just pay the fixed interest rate payment that they had initially decided on, which was 5%. So that's the main difference between a swap and a swaption. This brings us to the end of our presentation about swaps and swaptions. We hope you guys liked it and understood it as much as we understood it while writing this report. Thank you.